and underwriting times. But if you can't meet rec, there's still the traditional cash out refinance out there. But if your purpose for the refinance is to pay off debt, then the rec loan certainly makes sense. So to answer your question, I know that was a long way around, but to answer your question, yes, you can use the rec loan to pay off your boat. And rates are still low enough that it makes a lot of sense to do that. So it's a great time from the standpoint that there's a lot of equity in the property. You're getting much lower rates than you are in your consumer debt to pay that off. And home improvements is another place you can use that cash out or the rec loan to pull some cash out, because a lot of people who took equity lines are going to see those interest rates increase as the Fed starts bumping rates up later this year. And I don't know which reports are accurate, but I've seen as low as 4 predicted rate increases for the year and as many as 11. And I can't imagine 11. If he's going to do 11, he better get started soon, because that's going to start hitting us hard and often. But somewhere between 4 on the low side and 11 on the high side is what we are seeing in the crystal balls of the soothsayers, if you will. That was hard to say. I spit all over myself with that one. But the people who are much smarter than us, or at least get paid to pontificate on the economy and interest rates, are calling for somewhere between 4 and 11 rate increases in the next year. So that home equity line that you may have used to remodel the kitchen or put in the pool, that rate's going to start moving up. So you're going to want to factor in those increased expenses moving forward, and maybe look to one of these rec loans to pay that off. And if you haven't tapped an equity line yet and you're looking at it moving forward, maybe a cash out refi, just a bread and butter old fashioned cash out refi may make sense, instead of starting with an equity line that you'll need to absorb later when rates are higher. So all of those are things, rather, that you want to consider when you're doing this. So if you've got some assets that you're going to hold long term, like I mentioned, this gentleman's equipment, or a lot of boat loans are 20 years. So if you plan on that being with you for that entire term of 20 years, then rolling it into the mortgage may make sense with one of these rec loan products, or with just a normal cash out refi, because rates are only going to go up from here. And we talked about it in the first section. These are other ways to hedge against inflation. And by inflation, we're talking about all the expenses that we experience as a consumer. So your credit card payments, your boat payments, your equity lines, all of those loan products are going to see higher interest rates once the Fed starts, he pulls his 6-shooter out and starts firing away at these increases. So I just share all that because you're equity rich right now. It may make sense to move some of that around and offset those additional expenses. So thank you so much for that question. Yes, a rec loan can be used to pay off toys. They're not just for credit cards. You can pay off boats, jet skis, whatever you need to pay off, as long as we can make it make sense on paper and we're reducing your outflow. So there is my cue. I love that song. We are going to be right back after this break. I encourage you to hit the Anytime hotline, 561-291-8569. That's 291-8569. Or visit us at mr.mortgage. Thank you. Hey, it's Mark Eitel here, host of the Mr. Mortgage Show. And you've heard me talk about the valuation tool that we use in our lending practice almost daily. It's not quite an appraisal, but it's way more accurate than one of those online estimates. And we're happy to run one of those reports for you at no charge. Just visit freevaluereport.org. That's freevaluereport.org. Give us a little information about the property, and we'll be happy to send you your report. That's freevaluereport.org. Are you a rock star real estate agent? I mean, truly one of the best? If you are, let's talk. This is Mark Eitel, host of the Mr. Mortgage Show, and we are currently expanding our network of rock star referral partners. If you think you have what it takes, we'd love to connect. Just visit mr.mortgage. That's www.mr.mortgage. There's no .com. Just type in mr.mortgage, hit the contact us button, and let's talk. It's not every day that you need an appraisal, whether it's for a divorce settlement, estate planning, or maybe you're appealing a tax assessment, or you just want to make sure you have adequate coverage in your property insurance. When you need a certified appraisal, turn to my friends at soflappraisal.com. That's SOFLappraisal.com. Peter and his team have been appraising properties here in South Florida for decades. SOFLappraisal.com. And tell him you heard this on the Mr. Mortgage Show.
Here's another 5-star review.
We started our loan with a different company. They said we were approved, but at the last minute they told us there was a problem. I still don't know what went wrong, but thankfully our real estate agent told us about Mark. I was pretty stressed, but it's the perfect house, so we gave Mark a shot. He got it done. I'm not sure what was different, but I don't really care. We even got a better interest rate and with less money out of pocket than the first guy quoted us. It was a great surprise. Yes, I'm happy to recommend Mark and his Mr. Mortgage team.
Welcome back to the Mr. Mortgage Show. Call us now, 561-291-8569.
All right, I'm Mark Eitel, host of the Mr. Mortgage Show, and we are back. Again, anytime hotline, call or text your questions to 561-291-8569 or visit us online at www.mr.mortgage. Leave off the .com, just type in Mr.Mortgage. So, to wrap that up, the rec loan is a pretty powerful refinance tool that you can use to tie up a lot of financial loose ends and pay off some other consumer debt. So thank you so much for that question. We're going to keep this party marching in the streets. I know we got some additional questions that came in, so I'm going to kick it over to Dom, the producer, and see what he's got for us. Any more questions there, Dom?
Yes. The next question I have is, what is mortgage insurance?
Oh, the dreaded and often confusing mortgage insurance. That's a great question. So when you're buying real estate, especially for the first time, my God, do you have to buy a lot of insurance? And what is all this insurance? You have mortgage insurance and homeowners insurance and windstorm insurance and flood insurance, and there's insurance for my insurance. What is going on? So what is mortgage insurance? A lot of people confuse that, and I get the call and they say, "Hey, Mark, there's mortgage insurance quoted on here. Is this my homeowner's insurance?" And the answer is no. What mortgage insurance is, and I'm going to use round numbers again because I'm a very round number guy. So 80% is the magic number for a lender to have a comfort level with risk exposure on a property. So if you were to purchase a property for $100,000, you could get any lender to loan you $80,000, and they're very comfortable with that risk exposure because in this circumstance that they would have to foreclose on the property, there's 20% equity to offset any expenses associated with foreclosing, and then their assumption is they can sell the property at a price that's going to recoup those expenses as well as pay them that 80% risk exposure. When you exceed that 80%, there's a magic tool in the lending world called mortgage insurance. And the reason it was introduced is a lot of lenders did not want to extend credit beyond 80%, which made it difficult for people, especially the first-time buyer, to enter the market because that meant you would need to have a 20% down payment. So this mortgage insurance product was created to insure the gap, if you will. So let's imagine that in that world of the $100,000 home. So we're back even past 1982 in that example, because I'm sure homes were a lot more even in 82. But anyway, $100,000 purchase. Let's say you've got only $10,000 or $5,000 to put down, but you meet all the other requirements for the loan. Lenders will loan that because there's mortgage insurance that insures them on that in the 90% example, that 10% gap. So that mortgage insurance that you're paying for, it does you no benefit. It's not for you, it's for the lender, so that if they foreclose and they only get $80,000, right, that 80% risk level, they sell the property for $80,000, just a $10,000 deficit. That mortgage insurance ensures that gap is covered and paid to the lender. So you're paying an insurance policy to the lender for borrowing more than 80%. Now, I say that, but we've got a brand new loan product that we launched at the end of last year that will allow that number to be moved up to 90%. So you can borrow now. There are definitely credit requirements and underwriting guidelines that have to be met, but it's a conventional loan product. It's not, abnormally difficult to qualify for, but you can borrow 90% without mortgage insurance. But that mortgage insurance is simply there to protect the lender, to cover the gap between 80% of the value of the property and the actual loan amount. So I hope that makes sense. You'll hear mortgage insurance referred to in several different ways. It's sometimes referred to as MIP. You'll hear realtors and mortgage brokers talk about MIP, which is mortgage insurance premium. That's the portion of your payment each month that goes to pay for the mortgage insurance premium. So if you hear somebody say MIP or MI, which is just short for mortgage insurance, or PMI, which stands for private mortgage insurance, all of those three terms refer to that policy that ensures the lender is covered in the event of a foreclosure that doesn't exceed 80% of value. So I hope that makes sense. There are some ways around it. The new loan product allows you to borrow 90% with no mortgage insurance. And one of the cool things about mortgage insurance is that, well, I guess there's nothing really cool about it. It's an expense, but it's good that it's there, right? Because it does enable you to buy a property without putting 20% down. But with a conventional loan, you can borrow up to 95% even as a first-time home buyer. You can borrow 95% and get conventional financing with mortgage insurance, right? So you're going to have to pay the insurance on that 15% gap, let's call it the gap, if you will. But as soon as the property appreciates or you've made enough payments to reduce the principal to less than 80%, and most lenders it's 78%. So as soon as your principal balance hits 78% in the form of appreciation or principal reduction or a combination of both, you can contact your servicer and let them know that you would like the mortgage insurance dropped. So it takes a phone call. Sometimes it takes an appraisal. If there's enough equity there that they can do a desk appraisal to drop the mortgage insurance, it's an awesome tool to use, the mortgage insurance, to get into the property with less than that 20% down payment. And then once the property reaches a value where your loan is reduced to 78% or less of the value, then you're petitioning your servicer to drop the mortgage insurance. So it's a powerful tool that allows all of us to borrow more than 80% to buy a property. So conventional financing up to 95% is going to carry mortgage insurance. There's actually even a conventional product out there to 97%. It's pretty amazing at the loan products that are available out there right now. But the mortgage insurance is not homeowners insurance. It's not flood insurance. It's not title insurance. And that's another thing that confuses people. That's another insurance I forgot to mention. So you borrow 90% and you buy a house. And if you're in a flood zone, you have to have flood insurance. If you're east of 95, you're most likely going to have Citizens write your windstorm. So now you've got a homeowners insurance policy. You've got a windstorm policy. You have a flood insurance policy. You have mortgage insurance, and you got this thing called title insurance at closing. So yeah, you're definitely insured against what not too many people know, but you're insured. So mortgage insurance covers that gap, allows you to borrow more than 80%. Title insurance, and we all see that commercial on TV now with the title lock thing. Title insurance ensures that there are no problems with the title. Could be liens, recorded or unrecorded. Nobody's going to come back from the history books and lay claim to your property. That title insurance insures both you and the lender for that purchase amount against anything that happened to the property title-wise, right? So if there was an unrecorded deed and Jeb left the property to cousin Earl, but they never recorded the deed, and 70 years later you buy the house and, who did I say, Jeb and Earl? One of their nephews or nieces comes knocking on the door and says that was really my uncle's property. That title insurance policy is in place for that. So happy to dig in deeper on all of these topics. If you have questions, just give us a call. 561-291-8569 is the Anytime hotline, 291-8569. Again, that rings here in the studio where Dom, my producer, will jump on the call. Or during the week that transfers to the office. So 561-291-8569 is the Anytime hotline, or visit the web, www.mr.mortgage. Mortgage insurance covers the gap of the loan amount that